Well, last week we discussed how a 4% interest hike from the Fed costs you, the homeowner, 30% more on your mortgage every month. So let's dive a little deeper this week. And we're going to look at how unaffordable housing actually has become in the United States. Here to discuss is the CEO of Real Talk Capital, Rob Luna. Rob, appreciate you being here.
Thanks for having me, Carl.
All right, so take a look at this chart first, which shows the affordability of homes. And we've seen a dramatic decrease, not in the cost of them. That graph depicts the affordability factor of it. What's been the contributing factor to this?
Yeah, it's interesting when you look at affordability and housing prices over the last few decades. There's always a different reason, whether it's a decrease in income, a rise in prices. But what we've really seen with this huge spike is just what you alluded to, Carl. We've had this huge run up in rates. And like you said, if you look back at the low of where we were in mortgage rates just about a year and a half ago, without prices increasing at all, you had close to a 50% increase in payment. And so as the Fed's been raising rates, prices really haven't moved up. As a matter of fact, in most areas, home prices have been declining, but it's that average monthly payment that we've seen the hugest gap run up that's attributed to that affordability. And if you listen to what the Fed is saying, that's probably not going to be changing anytime soon.
Yeah, that is crazy. Now, check out this next chart, okay? So this is the gap in affordability versus income. We see a dramatic spike in the cost of homes and a dramatic decline in the median income. Now, this chart depicts the fact that American home ownership concept has never been further apart, but we're obviously not seeing, any policies that are changing this. So where do we go from here?
Yeah, I mean, look, at the end of the day, there's a couple of things. We've got obviously monetary policy, which is what the Fed can control, but we also have fiscal policy. So when you talk about policy coming out of Washington, that's going to incentivize small businesses, that are going to lower taxes, that are going to do things to actually spur the economy. I think good luck with that. That's probably not going to be happening anytime soon. As a matter of fact, if you look at most of the agendas that are coming out of Washington, it's absolutely crushing, the small business owner out there. So I think those are the things that need to change long term. In the short run, though, there's going to have to be something to close that gap. And more than likely, you're going to have to see some type of decline in housing, probably a little bit further than what we've seen over the last year, to somewhat close that gap, to bring more buyers into the market.
So let's look out a little bit, maybe a year, 2 years, 3 years, 5 years, and start to project, because there's a lot of people I know that are like, hey, should I move now because I got to buy a house and it's going to cost me more for my mortgage, but prices are going down. So what is the happy medium? What should people be looking for, signs in the market, and how do they help make that decision?
Yeah, well, here's the challenge. And as you know, Carl, real estate's local. You can't just put a broad brush stroke and talk about real estate prices. And what I'll tell people is this: if you're looking to buy a home price wherever you're at, if it's under $1 million, that is market. Even if you look at everything we're talking about in terms of affordability, there's still bidding wars out there. Prices are still, pretty much stable. They're not rising right now. But let's look at a few things. Average days on market right now is still only 23 days. Wow. That compares to, 80 days typically out there right now. We have only 2.9 months of supply. That compares to about 6 months of supply. And if you look at what's attributing to that, look, we've got the millennial generation, Gen Z, that are new home buyers now. And let's remember, after 2008, the 2009 crisis, we have a whole new buyer in there. That's the PE firms, KKR, Blackstone. They're actually buying those single family residences. So if you're buying a home in that price range, I unfortunately don't see prices getting much better. Now, the higher end, where those people aren't playing, the luxury homes, that's where you're going to see the bigger price declines. And what I would tell those buyers there's no rush. At best, prices stay the same for the next year to 2 years. That's probably the area you can find some more bargains. But unfortunately, when you talk about that average home that people are going to be buying, I don't see much of a decline be coming in right now, because there's just no supply out there.
Right. Yeah, well, Rob, I live in Greenwich, so we have all specters of the market there. We got the $200,000 home all the way up to the $50 million home, and houses are still selling. But you know what? That's kind of a bubble in a sea of other realities. So, Rob Luna, we appreciate you being here.
Thanks, Carl.